What's up, guys? I've been getting a lot of DMs about people playing earnings and then blowing up their accounts or losing a lot of money in the process. One specifically sent me a message saying, hey Mark, I thought Nvidia was going to go down after earnings and it did. I got the 255 puts and they were in the money when the market opened, yet I still lost money. I was down 20% at the open and then it dropped even more. Why is that? And so I'm going to explain that right here. So implied volatility, let's talk about that. Implied volatility is the expected move that investors think an option will make for the life of that option contract. So if the implied volatility is, let's say, 20 or 30%, investors think that this option can gain 20 to 30% over the life of the option. If the implied volatility is 70, 80, 90, 100%, investors think that the option can move 100% over the life of the option. Does that make sense? Well, there's something called implied volatility crush. As you lead up to earnings, the contract's implied volatility increases drastically. Usually implied volatility is anywhere between 30 and 50%, sometimes lower, sometimes higher. But leading up to earnings, it gets much higher than that. And I've seen upwards of the hundreds, 2, 3, 4, 500% implied volatility. And that's obscene. If you see that, you should never buy that contract because the move after earnings has to be so dramatic for you to even make money. So let's talk specifically about the Nvidia earnings call yesterday. So Nvidia closed right here. This blue area is aftermarket yesterday, and then this green area is pre-market today. So it closed right here. They announced earnings, it fluctuated. Ultimately, it lost $8.81 or a 3.3% drop. So it closed here yesterday, opened here today. If you would have gotten the 255 puts, you would have been in the money right here. You would have been in the money. But let's just see how they moved. So this is the option of the 255 puts, 255 right here. Let's zoom in a little bit. So they closed yesterday at $740 per contract. They opened right here at $575 per contract. That's a 22% drop. However, let's see what happened in the stock price. The stock price dropped. So the puts should gain value, right? Logically, right? But no, they didn't because of implied volatility crush. The implied volatility was so high and the move that was implied that investors thought could happen didn't actually happen. And so the implied volatility, I didn't actually check it before earnings, but it probably was over 100% and it dropped. And as implied volatility drops, the premium of the contracts drops as well. So if you're thinking about playing earnings, take a look at the implied volatility. If it's above 60, 70%, try staying away from it. And I personally don't even play earnings because it's just like, it's gambling. If I want to gamble, I'll go to Las Vegas and have a lot more fun doing it. So if you enjoyed this video, give me a thumbs up, share it with someone, and subscribe to us on YouTube. See you guys next time.